Hi, everyone. Thanks officially for joining us for today's career talk with Michael Althoff. I'll introduce Michael in a few moments and get started with today's talk. Um, just want to cover some other business to start. Of course, the CQF Institute runs a lot of online events. We're happy to have you join us for today's career talk. We actually have another careers talk coming up on June 11th that I think was recently announced. It's about building sort of the perfect quant resume. So for those of you looking to break into quant finance or get ahead in quant finance, definitely a good use of your time. Of course, of all the things the CQF Institute does, it's probably best known for being the awarding body of the CQF itself, the Certificate in Quantitative Finance, which is the world's largest quant finance certification program. So for those of you on today's call who haven't earned the CQF or aren't currently in the process of earning it, urge you to go to cqf.com, download a brochure, join our next info session. Also, I'd ask you to put in your application to the program. We do have our early enrollment discount deadline coming up tomorrow. So if you've been thinking about joining the CQF for some time, now's your best chance to do so and frankly save a little money. So even if you're not entirely certain, I urge you to go to cqf.com and put in your application. And of course, you can put in your application for free. With that, I'll introduce you to Michael. Michael Althoff has 20 years of investment experience first as a fund manager for PIMCO, including a role as EMEA team leader for their Europe ETF capital markets business. Had a number of different roles. In 2022, he built the portfolio management and ETF capital market structures for alternative investment funds at Royalton Partners. But amazingly, in 2023, he launched his own company, Leif, which I urge you to learn more about. You can visit Michael on LinkedIn, look up Leif on LinkedIn, look him up online, and see and connect with Michael actually directly there. More on Michael, he holds a master's degree from the Ecole Supérieure du Commerce de Paris, excuse my very poor French pronunciation, and a doctorate from Humboldt University in Berlin. He is, of course, also a holder of the Certificate in Quantitative Finance, the world's largest quant finance certification program. But Michael is one of our star delegates. So thank you so much, Michael, for joining us today.
Thank you so much, Tristan. It's a great pleasure to be back. We've had this talk a while back, and I hope I can entice a lot more people to join, the portfolio management world. I think it's a very exciting world. Yeah, I hope this will be really useful for you. I hope a lot more people will join the portfolio management world. I think it's one of the most exciting jobs. What is portfolio management? Portfolio management is obviously you manage a portfolio. And when you manage a portfolio, there are a range of input factors into managing what is a grouping of money. Usually in the context of a fund management company, so money is basically collected in a fund, and this then gets invested in according to certain clients or client groups' mandate, and the rules and regulations of the jurisdictions where you operate. And so this is obviously touching on a range of points, from the regulatory framework, from a legal framework, from the availability of assets to invest in, as well as on the other side, the availability of investors to invest in such assets. And so the portfolio management or the portfolio itself, or a fund that results from this, usually a fund structure or similar, is you can understand it as a compromise between all of these input factors. And that's what you need to manage, the compromise within the mandate. So I've prepared a little presentation, which I will now share on the screen. So there's two worlds I want to introduce you to in portfolio management. On the one hand, you have the more liquid world. And when I say liquid, this would be anything that trades with daily pricing, daily price discovery, the flows that go through almost on or at least on a weekly basis, let's say. This is kind of in Europe would be the usage world, right? The ETF world. So we were talking about funds that replicate or compete against the S&P 500. These are structures that usually have an investment universe that is defined by a benchmark, and you try to beat that benchmark. So how does the day look like? Well, you come in the morning, And the first thing you do, you try to, or you should be there ahead of market open, right? So these liquid assets usually have some trading venue that is usually regulated, where these trade. They will be trading depending on what happened overnight. So if you're in Europe, what happened overnight in the US into the close, as well as Asia, for example, right? And so this is the first kind of a set of information that you want to have ahead of the close. Secondly, you will look at your specific portfolios. Did anything that happened yesterday get booked correctly? Are my trades in? Are they in line with portfolio guidelines? Were my simulations when I traded, were they correct? Is my portfolio composition still in order? Do I have during the day cash flows? Cash flows in portfolios might be coupon payments, dividend payments, divestments, client flows, right? And the client comes in, bought yesterday at NAV, now the money's in, you have to invest. Otherwise, you have mismatch risk. And obviously, divestment means client wants to move out. You have to basically supply cash at a certain time. Now, these points are usually for client flows. It's what needs to be understood is the assets that you invest in, liquid assets. They usually have some trading hours that are defined. So you need to be invested right around, ideally, obviously into the close of the day before. If there are some mismatches, you should be investing ahead of or into the open. Obviously, the open might have jumps depending on overnight news flow, and exactly the same for divestment needs. You will into the open read through what happened overnight, get familiar, and you will read it with a mindset of, are the assumptions within which I built my portfolio, that is the compromise between what the clients want and what is available to invest in my regulatory framework and legal framework and so on. You build some assumptions in where you want to go, what you want to invest in. You have a global bond portfolio, and you say, I want to have a touch more in this and that country, right? News flow comes in, and you verify your underlying assumptions. Why did I want to move in? Why did I want to overweight versus a benchmark? Or why did I want to outright buy such and such investment? And this will basically dictate a little bit your subsequent actions. Then you get up to date. Once you're through this kind of portfolio maintenance phase in the morning, you get up to speed on deal flow, right? What is available? Who wants co-investments? Is there new issuance of bonds? Is there IPOs, etc., right? And you will go through and check, is there something in line with my investment tilts where I want to move? Or is there something that helps me to get out of, etc., right? So basically looking on the deal flow. Later in the morning, as you have collected all of this information, you will basically have a range of investment committees meetings on structures, trade structuring, specifically on certain discussion of trade flows, trade programs. Trade programs might be we as a firm with whatever portfolios that make sense, right? Coordinating between portfolio managers want to be overweight this and that structure. You'll probably have a specialist desk which trades certain things, and you will engage with them in their trade program. And here that means essentially execution. What is my daily flow? What is my daily volume that I can trade? What is allowed in certain markets, etc. Right. So these are kind of second leg of portfolio maintenance, and then you will come within these committee meetings, especially towards investment decisions for your own portfolios, as well as for portfolios within the team and team structure, where you think an investment from the universe that I look at might make sense in your portfolio as well, right? So it's often, portfolio management is very often, or should be, a teamwork event. The more information you can cross across desks. So often you have portfolio managers specialized in one field, high yield, inflation-linked bonds, equities in emerging markets, equities in the US, et cetera, right? And as they find opportunities, they might come to you and say, look, Mike, you have this and that equity portfolio, it's European equities, but you have in your guidelines, it says you can also take up to 5% in US. We think this one is better than that one. Why don't you do a switch trade? And we will include you in a trade program, right? So these are kind of coordinating events where you say, where first you try to understand where you want to go to, what are the available structures, is this market overall cheap, rich, etc. What are the individual assets I want to buy within that market, and then you will devise a trade program and the preparation includes portfolio risk, compliance, pre-trade compliance, post-trade compliance, portfolio compliance, right? So all of these things have to be modeled and checked. Once you come up, then obviously it goes to trade execution. And here, usually trade execution is not just hitting buttons. It's about, depending on size, how do you smartly get it into a certain market, right? What is the daily flow? How much can we execute, etc. And sometimes you have two legs, sell this, buy that, right? How much can the buying and where's the bottleneck? Am I okay to sell? Am I okay to buy? Then you verify your trades, obviously, in the evening. Are all the trade tickets in? Is it in line with the portfolio simulation? And it's only your day only ends once all of the tickets are through, right? So there might be some compliance reason, setup issues. There might be, it goes down to is this and that account allowed to trade with this and that bank, right? It can go to that level. How much? Maybe there's a maximum number over the month. So all of these things have to be checked, and once they're through, basically you're done for the day, right? So that's a relatively typical portfolio management structure, and you see already that you will be touching a range of departments. It could be from structuring, legal, compliance, risk, right? Opinions on certain things. You might have in your market something that is being issued, a new deal flow that has elements which are usually used or which are typical in another market. So you will liaise with your portfolio management colleagues or your credit analysis team to understand how you would model such a structure. Right? And this goes every day. So you need to be on top of things. You need to be on top of changes. You live in a world where whatever you deem okay today might not be true tomorrow. And so it's a lot of gray, and it's strongly about probabilities, higher probabilities, and the probability not in itself, but also the price for that probability, right? So you have to think in that context. What is likely to happen, and what is the price I'm paying for this? Right. So you can also say any asset that has some positive potential for future cash flows, which you buy at zero. Which doesn't offer you a downside, obviously, but it's just upside, and is bought at zero, can be a AAA essentially, right? So that's kind of the logic that you want to have. Now, if you move into alternative investment funds, it's a bit different. You have right in the liquid assets, you essentially buy. If it's an ETF, you can buy on screen. If it is a non-exchange traded fund, you basically go to your bank or your broker or whatever, and you will issue an order to buy at NAV. There's usually daily NAVs because markets are liquid and you have daily pricing. Now, in alternative investment funds, these are assets which are by definition less liquid, and they don't trade frequently. Sometimes they trade, I don't know, once per year, maybe never, maybe every month or so. Right? Or maybe that asset doesn't really trade, but some other assets trade, and you need to derive a logic around it. So that's one thing. Second thing is, as you invest in alternative investment funds, you have a ramp-up period usually. So you open up a fund, you say, look, I'm going to invest in, I'm going to provide private credit to small companies in, fintech or something. And you go around, you collect committed capital from potential investors. And now you try to find investment opportunities once you've opened the fund and all of these clients are deemed okay. And then you will have basically the list of capital calls that is then pro rata being called. So somebody says, I'm good for 10 million, right? His pro rata shares maybe 1/5. So if a new deal comes, he will pay cash 1/5 of that new deal, right? That's your invested capital. And then over time, you start the management of those assets and liquidity management around these if there are opportunities to divest out of a portfolio. Usually those portfolios, they don't have like ETF style, so basically they're closed funds, that's how we call them. They're not open for leaving. And so you will have to think about liquidity management within your fund guidelines as well. So it's a bit of a different viewpoint compared to assets that are more liquidly tradable. These are deals, loan deals, for example, right? There's basically a document that encompasses all of the important items for a specific deal. So you will have investment committees that will check and verify the performance of individual assets, right? So that you've invested in now and made capital calls. And you will also have deal sourcing. So basically, you'll go out and say, look, I'm looking for, what did we say, private credit in fintech for rollout of structures that are, post products, works well. They just need cash to roll out their business, basically, right? And you have a kind of relatively constant forecastable deal flow, income flow. So that would be right. And now you have to go out to companies, brokers, etc., sources who look at all of these individual companies and come back to you and say, look, Mike, within the mandate that you have and within the qualifications that you handed out to us, we think these 10 deals make sense for you, right? So you will go through quickly with the investment committee and you will say, well, okay, let me filter what is compatible with my alternative investment fund mandates, for example, if it's an alternative investment fund or some other collection of money, client money, essentially. And you will have basically do a pre-selection and then on the initial data, and then you will basically go into further deep dive in the due diligence process. And due diligence is very important in this asset. In the liquid world, it's usually companies that have, they have their audits, they have regular filings on a frequent basis, let's say quarterly, on what happens in the company. You have, CEO, CFO calls, you have shareholder meetings, etc. So you have constant flow. In these mini deals or smaller, they're not in these less liquid deals, put it that way, you don't have that, right? So you'll have to engage with the respective company. They're not publicly traded, probably. Definitely, or most likely, your deal is not really publicly traded. They could be, but maybe not. And now you need to have your own more deep dive into what's happening on the ground. So you will go into the pricing. You will already have a due diligence process. This is like tax due diligence, legal due diligence, etc., etc. You check on the ground what's happening, and you will initiate all of your input matrix for pricing of the respective deals, and then essentially, right, so you will initiate with the respective assets, like an investment offer, let's say, around so the asset, which would be, for example, a loan deal, right, or a loan document. You finalize the pricing model, and you will know about the inputs into the pricing, and you will have a pricing event where everybody's live. For example, we think this asset in, I don't know, Ecuador should be, it's in dollars, so it's, where does foreign currency in Ecuador trades? Dollar government bills plus some credit spread plus this plus that plus liquidity spread, right? You come up with a matrix where you think this is where my coupon should be. So right, and you say if it's a loan, and then similar for equities. Okay. Now that you've basically went into a pricing event and the deal is now live, now is the initiation of the individual asset management process. So in alternative investment funds, you have to track each and every asset ongoingly, right? You have to find a system that gives you as much information as possible. Right? It could be, the balance of the treasury, the monthly EBITDA numbers, how are sales going, etc., etc. Right? So you'll derive numbers that are bespoke for that asset, and you will track them. And if it's anything that helps you understand if the business is going okay, because you are the one looking at it, and if it's an unrated deal, then probably maybe a yearly audit, but basically you. Helping you is obviously your setup of operational due diligence, right? So those are people who most likely the people who've done your like a feasibility study in the beginning of around the asset, but they will help you looking at individual data. Often on the board of the company, you will have somebody from your entourage, let's say, and this goes over the life of the asset, which could be until it's a bond or loan until it's in maturity or an exit, etc. So it's really something that you have to. So So the process in private assets is less scalable compared to liquid assets, right? So you can't just do too much of simple machinery. It's a lot of individual work that's to be done, right? So it's something to be kept in mind if you want to do a good process. And then you have as well, where it comes in is asset valuation, right? You have to derive some way to give value to these assets for pricing dates, for example, monthly, quarterly, yearly, maybe. And obviously, you have ongoing risk and compliance inputs that might go into the valuation, that might go into portfolio structure, and so on. Right. So it's a bit of a different world. In the alternative investment world, you also often have during the ramp up period, call it 3 to 5 years, as you have committed capital. Now you start investing, right? You usually have leeways given to you by the regulatory and legal framework. For example, you have 2 to 3 years to bring this portfolio to a diversified setting, right? So you have 2 to 3 years to find a couple of deals. So in the beginning, if you have just 1 or 2 deals, obviously it's not nice, but it is what it is in the beginning, and you will work to get to a more diversified portfolio, which is obviously what the end client needs. Right. So again, as an alternative investment manager or portfolio manager, you would be in touch with not only your internal department and obviously be on top of things in terms of regulation and rules and all that. You need to be working with experts from outside the company setting, and they will give you inputs into your investment committee, right, to understand what's going on the ground, right, to look for opportunities, but also to manage your opportunities. Okay. So with that out of the way, what is the portfolio management ecosystem, right? And I will give you some examples of items you come across or that I came across during my portfolio management career, and it will give you an idea of what things are actually necessary in pricing and why quant finance expertise is needed. So, for example, mortgage pool pricing, right? You have a mortgage pool is basically a collection of people. You try to let's say average out risk, right? And you have a pool of people who have loans outstanding against their houses. Now they have different characteristics, right? Family, career, location, size of house, etc., leverage, right? So all of these things can make up very big data matrices. And now some of these mortgages might give you the option to prepay under certain circumstances, right? So there's an optionality embedded, which is not, which is more, let's say, indirectly modeled indirectly, right? You don't know if people execute on it, but they might, so to speak, feel in the money, and out of circumstances. So here's a modeling approach where you take option theory, maybe under distributions which are not normal, and you will have to come up with a pricing that is relevant for that pool of people that you try to understand, right? So it's a various large data input factor. Event-linked bonds might be bonds that are linked, for example, to weather events, right? Flooding, windfall, etc., etc. So here the input is how likely is this and that event over time? Can we take ideas from climate modeling into our input prices? It's usually these bonds are issued at 100. They pay you a high coupon, so you want to understand how high should the coupon be to, on average, be still profitable if such event happens, right? And so here it's again the modeling that is outside of finance and translating it into financial numbers. Inflation-linked bonds is sometimes they have, so you issue a bond at 100, and over time the inflation over the, let's say, 10-year time is being paid at the end. So over every year you basically accumulate inflation pay compensation as measured by the respective statistics office, and you have a backloaded payment. So if you have a bond that is issued with credit risk, then you need to adjust for that, right? How do you do that? You have to basically look at the credit swap market and then take, derive risky discount factors and so on, right? So this could also be down to client mandate. Some clients say, look, within the regulatory framework, I have to hedge against inflation up until, let's say, 3% or so. but beyond that, I don't need to, right? So you have to find a way to hedge against inflation up until a certain point and beyond not. How do you hedge that? Is there a market in caps and floors in inflation, for example? Are there other measures I can do? Are there more indirect ways to do it, etc.? Right? So this is sometimes the client input is also important for you to understand in the portfolio context what the client risk is, and then finding ways to. So this is your benchmark, so to speak. Distressed credit modeling, credit default swaps we've touched upon before, so I'll leave it at that. Securitized deals is basically somewhat goes into kind of mortgage pool pricing, but essentially what you do is you tranche a deal into more senior or AAA and then further down, right? And so they get hit by credit events. They get hit first in the lower rated tranches, and then latest the triple, so to speak, hopefully AAA tranche. And so how do you model that, right? So here quant finance knowledge comes in, and how do you manage it? So you have to manage these individual deals within your portfolio context, right? What else do I have in my portfolio? Does it make sense? Is this would this derive or would this lead to clustering of risk? What is the factor that defines this risk, and how can I see covariance matrix, for example, in linear terms, or correlation matrix, and in simpler linear terms, for example, right? These deals often have a nonlinear payment structure, so you need to obviously find ways to model that as well. Now, it could also be on the level of the portfolio itself. I give you an example for ETFs. ETFs usually, not always, but usually have an underlying index that you try to track. Now, it could be that you are invested in a specific ETF, and if you took the sum of the parts, basically all of your holdings, and take market prices, this gives you a price of, let's say, 99.5, but your ETF maybe trades at 100 at a premium, or maybe at 99 for whatever reason, liquidity usually, etc. Right? And this is because sometimes there's higher liquidity in ETFs compared to the individual markets. So sometimes if you want to have an ETF, you want to hedge the equity risk, right? And you're not going to go and buy the individual S&P 500 bonds to hedge. You're going to buy something that replicates that. Right, so an ETF sometimes has this liquidity premium. So these are things that you need to take into account, and maybe that is important as you go. So these are from various angles why quant finance is super important in portfolio management. In future you will have to learn to take your quant finance surrounding and augment it by alternative data, let's say. And this is in the context of AI. So the inputs into pricing. I'll give you an example, and then you'll understand. I had it in basically European inflation bonds. Inflation has some part which is in, or a larger part is in food, and food in itself is also very volatile. So it has a lot of input on subsequent inflation prints, right? One input factor into food inflation is obviously the crops. For example, winter crops. How are winter crops in, so you understand where do winter crops, where do they come from? For example, Ukraine, or maybe back in the days, Russia, delivered into Cairo. So you want to understand how are winter crops going? How do you know? You can send somebody, check, or you can take alternative data sources. And more we had satellite imagery. This also was, for example, container shipping. How many container ships and how deep are they, right? So you know how are they fully stacked, or is this is the economy slowing and there's not as much being shipped, right? So these are all things that you get from alternative data sources, and sometimes you will start, sometimes you'll find past data, sometimes you won't find past data, right? And so these alternative data sources have to be somehow quantified in a way that it helps you in your asset pricing and valuation models, right, as an input factor. So that's something where you need to be, I want to say, creative. I see something on the chat. Let me just check. Good, nothing from me. Exactly. So this is something that you have to move away, and that's some simple Excel sheets, right, which I heard are still being used quite a lot. Into, this is big data management. You have to you have to collect this data, be precise how you manage that data. Ideally, you cross-learn across asset classes. I've learned this from that asset class, it syncs with the economic cycle. So maybe I can model that also into something else. You have to find a way to, if crops are good in certain region, likely the delivery into that and that futures contract will be high. So I need to understand, how was that in the past and so on, right? And how much is that in basically sensitivity to my asset, whatever it is, right? So the portfolio management role as a quant finance guy is away from only quant finance, right? Which is already a large subject, but also being creative about finding robust models with a lot of explaining power that in future you can use for your investment management, right? So and they have to be. Don't forget, this is not like a university presentation or a seminar presentation. This is a model that needs to work because you will be testing it in real life circumstances, right? So simple thing is, to overcome biases, for example, is right in sample, out of sample, simply, right? I model something in sample and I test if it works out of sample. And if it's not robust, then probably not. So robustness is important in this context, and a strong mathematical statistics. You need to really understand why a certain model gives you a certain result. It could be simply be the mechanics of the model. It's or that you use, right, rather than really underlying data, right? If you use let's say R2 R squared for nonlinear data, it doesn't work, right? So that's what you need to keep in mind. Okay. Then what I want to leave you with also is that in future, as you have these, the things that I touched upon in the beginning, you will need to be in future to augment your work, to be competitive in this market, to augment your work by improving models and improved data management. You need to be able to use as much data as possible. Now you have only a certain time to do reading, right? Across the day, given you have your private life, right? So there's one thing that during the day, as I've touched upon, you'll be talking about deal execution. You will be working with the compliance department, risk department, the client flow, the sales team, et cetera, right? So you need to find a way to be extremely efficient in managing the incoming data. And it's in a context of, we have now a lot more over the last, let's call it 10 years, a lot more computing power and a lot more data availability in all formats, right? And you need to be able to process all of that information. Now, the one way to obviously to go is to hire even more investment analysts. It's probably not the right way to do it, right? You want to go more machine learning. So you need to be able to augment the way or the amount of data you can model, or that you can consider in your model. That's going to be a key item in the near future, to be honest. And in our company, this is exactly what we will focus on. So your portfolio management will be basically high value added decision making, augmented by the data that you've sourced through various means. Okay. Scraping, et cetera. You will collect this data in a smart way, right? So you need to have somebody who's good at basically storing that data. You will manage that data in a way. You have to protect that data, because this data is your gold mine. This is your future gold mine, this data, right? It's similar to Tesla cars. Tesla cars drive around, they film and everything that happens around them. And it's basically a data collection scheme, let's say. So similar for you. Take as much data as you can, do your data analysis, go back to your models, test them, right? Check robustness, improve. Check robustness, improve. So your daily work is going away from only modeling a bond and sourcing deals and seeing if they make sense and understanding your portfolio context, to also understanding them in a context of more and more data availability. And so it's a key feature that you need to in your career improve. Okay. Then obviously you want to translate it into executable decisions. Remember that your model is something that you have come up with. And there's no I don't want to say there's no certainty. I actually want to say it's for sure that your model is wrong. It can't take all of the information and decision making by individuals that have somewhat an influence on the deal, right? It's a proxy, and it worked under certain circumstances, but maybe won't work in future. So this is what you need to take into account as you manage this, right, and improve your work. So your daily work that I've outlined in the beginning will be also including the data that came in and how did it change your models. Okay, so that's a key feature within a legal and regulatory framework, right? You are obviously, right, AI, and how's AI being incorporated? This is automatic, etc. Right? Most likely you will have, that's why I call it augmented portfolio managers. You will have input factors that no longer come from credit analysts or less so, but they come now robustly from your tech setup, put it that way, right? And but this has to work within you have some dependencies. Where's data stored? If data, if the data center's down, can I still take decisions? Do I know what's going on, etc. Right? So these are new considerations in Europe, right? We have the DORA coming up, regulations are. And so that's why I say continuous learning in that context is also important, because as you collect data, you will face new problems. And so it's good to keep up to speed. So one good thing is seminars and events at CQF, but also university talks, presentations, go to seminars organized by players in the field. Learn as much as you can, because this will broaden your mind and improve your modeling. Right? So it demands continuous development. That's really what I want to leave with you. Now, you are still a human being, even though I said future job likely very augmented. But there's a range of, Montier, if you get hold of the 7 Sins of Fund Management, really good for you to read. Forecasting, the illusion of knowledge. You want to meet companies, you will be influenced by them.
Yeah. Michael, thank you so much, first of all, for today's presentation. But before we get into specific questions, a question we normally get, which I was hoping you would address, which you've addressed a bit as we've been going along, becoming a portfolio manager, right? Your first role, sort of what are the routes into a role, as a portfolio manager, being part of a portfolio management team? If you explain that, I imagine a number of people would benefit.
The usual path is you will join a company as like an analyst level, right? And usually a certain market where you will be tasked to analyze deals, for example, or analyze structures or model, or et cetera, input for the work of the portfolio manager. And you yourself also will be trying to use as much data and technology as possible. And over time, you will be tasked with more and more influential work on the portfolio management, right? Michael, look at in the past would be Michael, look at my portfolio and check if this and that. I'm unfair. I'm not too happy about my liquidity position. Find solutions to improve. Right? Okay. So I go through and so on. So you'll have these tasks over time that directly right? And over time you will become usually like a secondary portfolio manager, right? So if the lead portfolio manager is out, you are the one in task, right? And this is basically a usual step. It will take a couple of years, right? And it's essentially because you will be touching on so many aspects that it takes time to really be proficient in this job. But take this time, use this time as much as possible to accumulate information, and then you will go. Also, one recommendation I can give you is go out and ask for more work, right? So look, I'm doing in a way like, I'm really interested. I modeled this. This was great. Okay, do you have something else that I can go to improve my knowledge? Or you see something, look, this and this is not really taken care of in our company. Can I take that sector and learn, right, about this little niche and so on, right? And then as you're an analyst, you will give inputs, right? I see this and that. This could be a trade. Look at this, right? And so step by step, you start thinking in a portfolio context, right? What does make sense within the setting? And that's usually how this career path works. A lot about trust, because the portfolio manager needs to trust him because he's being trusted by his clients, right? And the company, right, who hired him to manage portfolios. And so he needs a trustworthy, robust team with a consistent structural approach. So that's basically what I can say. But the usual path is analyst, right? Investment professional, and then step by step, you'll be diving into it.
If you're starting as an analyst, you generally have a tight set of assets, maybe one particular asset you're looking at. Do you have multi-asset responsibility? How does that work?
It depends who you work for. If you work for a multi-asset team, right, you would look at many assets and say, how do bonds compare to equities? Do a study, right? If you work for the high yield portfolio manager, then you would look for more likely on the individual deals. New set of data came in, right? They filed their quarterly reportings. Go in and please analyze, right? Listen to the CFO call, see if you hear anything, right? And what you will do as the new future quant finance and AI guy, you will also switch on a sound detection on the voice and say, look, I think, this and that, right? And that's how you have to think. You have to supply, you have to make it easy for the portfolio manager to manage the portfolio. As you make it easy, he will include you. And that's how you move up.
That's great perspective. Thank you for that. How is ESG analysis considered in your asset valuation process for alternative investment funds?
Take an example. I have, I don't know, a PV installation company that is now going to install PV, so solar, right, on the roofs of XYZ project. And here in this context is, is that the ESG analysis would be what is the opportunity set? How did they use energy before? How after? How does that compare? Right? It might derive a certain carbon credit payout, or right. And so these are things. So that's on a bespoke within the asset valuation process. Well, it depends on the asset, right? If we have an asset that is directly linked to certain payments out of the sustainable finance universe. Let's say, for example, you're financing a project that generates carbon credits. Then here your asset valuation is dependent on if it's nature-based, the biomass credit. If it's a carbon capture, is the machine working, right? Understanding that, is the machine capturing enough CO2 and storing it somewhere else, right? And how much is that? And that goes into your valuation, right? It could be more further away in that they say, Michael, why don't you invest in this in that country, but we want some co-benefits. Co-benefits would be women into workforce, the UN's basically sustainable growth targets, women into workforce, proper contract, et cetera, right? And all of these items need to be, would be in it, but it's really deal dependent as well as portfolio context dependent, right? If your mandate says, I'm in, for example, European SFDR Article 9 fund, then all of these things need to be detailed. You'll have a company that goes in that verifies, right? If there's a company, if it's linked to, let's say, your projects, for forestation, biodiversity is important. So you have to have a company that does biodiversity check. If they say, yes, it's more diverse compared to the past, compared to benchmarks, etc., then yes, the deal is good. We can continue, right? Or you might have a credit event. So this is basically how it depends on the context. Could be more broad. Let's do something good while we invest, or more specific. Actually, this is a cornerstone of our investment. So we need to make sure that everything that we do within that asset is being controlled and checked and verified.
There's a lot, I'm sure, a lot of political questions that could follow on from that as well. But that's a great analysis of that. So thank you. Let's go to Chris's question. It is not uncommon, Chris is asserting, it's not uncommon for managers in less liquid markets to be organized as hybrid teams with quants and fundamental analysts. The information is usually combined in an ad hoc way. Can you suggest a better method? That might not just be the case. Well, if you could speak to that being true, first of all, for less liquid markets, maybe markets overall, and then address the rest of the question.
Yeah, so there are a range of qualities that come in, right? Let's say you have an asset. Well, what did we have before? Carbon credits. Okay, you create carbon credits, and there's a contingent payment. If carbon credit pricing is above 15 on average, then you will get an extra payout in addition to your coupon. Okay, now, how do you model that, right? So it's a quant finance question. Maybe there's no forward curve. So how do you model that, right? So that could be like an AI statistic question. So a lot of teams come in and have to come up and talk with the fundamental analyst team to do that. Now, these are, if you try to, let's say, copy paste the deal from one deal to another, then you can replicate. If deals are coming in and they're very bespoke, then this is the scalability is not really there. Now, one way that we will be employing is obviously your own in-house language model, right? So you will accumulate as much data as you can. The future portfolio management company will accumulate wherever it touches, whatever deal it sees will accumulate that knowledge, and you will work with that model to pre-derive certain elements. And where it's still open, your team still has to go in and do the non-scalable part and come up with that. So that's roughly where I can say it. So I see a much bigger impact from AI, shall we call it, tools into the less liquid market than the liquid market in that respect.
So I'll ask Yi Yang's question. Thanks for the presentation and your example about using AI in quant finance. Do you hire machine learning scientists or collaborate with an AI-focused firm? If it's the former, how many machine learning scientists do you have?
You will hire as few as possible, but as many as possible to get your work done, right? So in a sense, difficult to say, but the gist is you want to ideally, if you have your own data that you collect, you will want to have your team as much as possible internally, right? Because anywhere where you touch outside, there's issues of data being somewhere. This is your goal, right? This is your gold mine. You have to protect it as much as you can. So that's one thing. Secondly, in our case, we think that the way we will do things gives us certain advantages versus the competition. So you don't want to share that with somebody who might learn from that, right? So now there are tasks which where I don't want to be a core, which is not my core competency. Machine reading a certain document that is handwritten or something, not my competency. I will just have somebody, I'll use a tool, ideally in a way that it's that data doesn't leave, but I will use an existing tool to read handwritten data, papers that are being scanned, for example, right? So this is not my core. My cornerstone is once I have that data, I process that data. That's then again my cornerstone. So you will split the individual task in something that is not my core business and something that is my core business.
So extending from that, do you see more of that work being outsourced to firms, right? Because it's not their core expertise. You think there's more growth opportunity in consulting companies or startups, or is it going to become so available that it's sort of easy to insource? This is more reliance on AI.
Yeah. So you will have a range of things which are much better done by professionals in, as I said, handwriting. Okay, reading handwritten notes or deriving sentiment from the voice of a CEO as he speaks. Okay, is he lying or not? Okay, and so you'll use that input. Okay, so that makes sense. And then if you wherever you think this is data that only I have, nobody else has, you will work on your own model. And you will hire as many people as necessary to process that, and until you find a way to translate that into quantifiable data that helps you on pricing and valuation.
Excellent. So a few more, we're going to circle back to some more career-oriented questions. Jan asks, I'm a trader, PM on an ALM desk in Treasury and want to move to hedge fund prop trading asset management firm. Is such a move possible? Do you think it is possible to move without a downgrade?
Yeah. So as you move careers, there's you sometimes have a dip in your career as you make a move, right? Ideally, you have like a path of productivity, and then you plateau. Now you try to find something that builds on that plateau, and you go further. If you do a career step that dips, then could be problematic. But it depends. It depends on the outlook, right? So now for his specific questions. You might have some knowledge. So if you join a hedge fund, you probably have some, they will give you a certain amount of risk and you will, and a market to trade. Your market will be, for example, I don't know, trading, what did you say, ALM? So you'll know the flow, in and flow and the out of the ALM participants, right? The insurance and lifers and whatnot. And as you understand that, you probably have a way to trade against it. So you'll start with that. Right, you take something that you know, and then you try to build around it and improve. Right, it's definitely possible. I've seen past colleagues who went from more standard portfolio management into more hedge fund type. But yeah, it's a thing you have to like. It's a different setting, right? There's a stop loss, and not only your portfolio is out, but you are out too. All right. So that's something to keep in mind. Payout structure is different. It's not for everybody. But if you take knowledge from your market that you can implement in a structural way, maybe you see a structural trade that you can do. This flow comes in, then you trade this, then I move out again, and this over time always makes me 15% per year. And if I leverage that and all that, fine, right? If you don't have that specific knowledge that gives you an edge over everybody else in the market who is probably as well as informed as yourself, right? Think about the biases then that you might have, right? Then the illusion of knowledge, right? If you're certain about the edge, right? Sin number 3, then you might be okay.
If I could just say too, in a general sort of sense, anytime there's a risk to standing still sometimes, but there's generally a risk in moving to a new company or into a new role. And it's not just a matter of, are you looking at it as a downgrade just because you're making, X dollars fewer, but then what is the upside going to be for you too? So there's always, it's not just about that dollar calculation, right? It's about the risk, but there's risk in doing nothing as well often.
Yeah, so it's also in the context of, as you've worked for a certain company, you have your network, and your network has a certain value, whatever you want to come derive it, but it has a certain value. You move to a new place, you might not have that value right around you. So especially in a hedge fund context. So that's also something to consider.
Jerry, so thank you, by the way, for that question before. Jerry, how does the quant PM differ from a traditional PM?
Traditional PM is probably, let's say, the fundamental guy who reads things and then does some bank for buck calculation kind of thing, right? Back of the envelope and says, this looks like a good deal. So that's, I'm maybe exaggerating. And a quant finance guy goes much more into detail into the optionality, modeling the optionality and deriving a much more precise number. And the trade implementation is sometimes more complex because you learn to compare various markets. Whereas, often a traditional portfolio management is long only. You might have the way to put up a trade that has some hedging elements and contingent payments and all the rest of it, right? So that's basically essentially the difference. The traditional PM should be knowing as much as possible about quant finance because that's an input factor into any embedded optionality into his bond. You as a quant finance guy, you want to actually put a value to it. How much should my coupon or my dividend be higher, lower? Because this and that could happen because there's some contingency in the overall structure.
Thank you for that. Lots of other good questions. I'm going to take 2 more. Gosh, I guess we'll go to Tim's. This is an interesting one. When building an in-house model, how do you ensure confidentiality? He remembers that a particular company made everyone a partner of the company, I guess, to ensure the confidentiality.
Okay, it's a contractual setting, and then obviously incentive based. That makes sense. So whoever touches that should have an incentive for long term warehousing your gold mine. So very true. Data leakage is what it is. You will we obviously mark our data, so when it goes out, we will know, and we will know who it was. So that's another way to do it, but the leak is there and the data is out, right? But it's primordial to protect your data in any way possible. And incentive structure is one way to do it.
Hey, Michael, how is the current trend in large language model adoption affecting the industry and assisting your daily workflow if used?
It's a massive influence. I think it's underestimated, especially in alternative investment fund industry, which is often very textual. And it's if you look at the data, so you ask a question, you can run several models and check robustness between the replies that come back from the various models, right? Did my assets in such and such country perform well when the sun is shining or not, right? And essentially, is the replies you get back are pretty robust. But think about it. It's all about the data management you do, right? The model is not magic. All it does is translates the text into a vector of numbers, and more or less, and essentially it will say, yeah, this is very very close to that, right? And in this hyperspace, and so it's all about your data structure management. And as we get better and better in doing that, and better in taking unstructured language into more data frames that we can use, this will be a lot more input factor. So in future, you will have, I give you an example, you have a private asset deal and the new information comes in, your new balance sheet. Compare me this balance sheet to the last 5 years, as well as to this and that, right? Boom, within 5 minutes, you're there. The analyst probably takes, I don't know, 1 day or so, or 2, right? So you're extremely fast. And this will be quite disruptive in a way that a lot of people don't yet understand.
To echo that point about the models not being magic, obviously that's Paul Wilmot is a big believer in that you have to know what you're doing, use the models for good, not for evil. And that'll take us to our last question. I want to get involved in portfolio optimization and modeling. I have a CQF and a master's degree, but very little experience in the finance industry. What do you suggest?
Get in there. So, it's find maybe a range of assets that interest you. That's always good, and where you have touched maybe in the past some way or another, and or where you have certain liking, right? Some like high yield, some like bonds, some like equities, whatever, right? So that's one thing, and then and understand where you want to be, more in investment banking, more in investment management, et cetera, et cetera. And once you've more fast-paced investment decisions, slow-paced investment decisions, and then go in with internships or I don't know how old Jorge is, but internships, for example, traineeships, et cetera, analyst jobs. Go in, get experience, and learn by doing. You at some point, you're done learning, you're done doing theory. Now you have to apply. So that's it. You have to do.
Would he be more likely to find success maybe with a consulting firm or a smaller hedge fund? Like if you were just looking to break in and you were, let's say you didn't care which set of assets you worked with, what do you think would be your best foot? What would be the place where you'd be most likely to get started?
Consulting could be one part, depending on the consultancy, but you might get stuck, right? He wants to enter the financial industry, really. So those are people who watch the financial industry as spectators, right? But they're not participating. It's a difference to exactly. You see what I mean, right? And here you have to get, if you want to go into portfolio management, you have to expose yourself to an environment where you take decisions in a gray environment. Nothing is black and white, and you have to take decisions, right? You can always do a consultancy presentations and might be wrong tomorrow. It doesn't matter. But if you have a trade open, then it does matter. So you have to get exposed to this environment. And the only way to do it is get in. To be honest, careers are non-linear, right? You go in here, you go in there, find somebody, something that you like, but maybe you have an access, somebody and you start there and then you go from there, right? You can't program your life. It's not, you're not an Excel sheet, So
internships too. And Jorge, I would suggest you reach out to Sonia Aurora, who's on the CQF Institute team. You might have spoken with her before.
That's
but,
right.
The function of that office is to help help really all our delegates, but particularly our new grads to procure a position. So, and the CQF network can help as well too. You might want to just look on LinkedIn and see where CQF alumni work near you. Then there's good old-fashioned networking, which always helps.
Another thing that I've seen helping more and more is people can have their own portfolios that they trade. Can be small, doesn't matter, right? And you do a little bit of ETFs or all asset ETFs, and you show performance over time, and you can explain why you have that performance, right? And then you add that to your CV. It's like, look, this is how I invest, and that's why I think it fits this market. I'm already doing it. You'll be invited, and then you go from there.
Excellent. Michael, we have a number of other great questions. Unfortunately, sorry, folks, we can't get to them all. But Michael loves when people reach out to him, so he's available for that. And so, round of applause, Michael. Thank you so much for today's talk. As always, very insightful. You can tell by the questions that folks are very engaged. So thank you for that, and thank you, folks, all for coming. We hope that you join us for all our talks that you're able to come, that you feel are relevant to you. And lastly, one more time, for those of you who haven't yet earned the CQF, who are thinking about it, do have our early enrollment discount deadline coming up tomorrow. If you put in your application today, I'm sure we can extend that deadline for a day or two for you. But I urge you to get in your application, or at least go to cqf.com, learn a bit more. I'm happy to speak to you myself, of course, as well as a number of folks on the team. But thank you for joining today. Hope to see you again soon. And Michael, thank you one more time.
Was a pleasure, and I hope it helped everybody to get in there. I'm excited to see you in future.
Cool. All right. Bye all.